Newton lost the equivalent of $4 million in just 6 months. In 1720, Isaac Newton invested in the South Sea Company. Initially, he got out with a nice profit, doubling his money. But a few months later, he jumped back in, swept up by the hype, and lost a fortune. One of his most famous quotes came from that painful experience: "I can calculate the motion of heavenly bodies, but not the madness of people." In 1722, Newton held nearly £22,000 in shares. Some sources say he lost £20,000. Today, that would be more than $4 million. The greatest scientific genius in history became a victim of his own emotions. Why? Because successful investing isn't about intelligence, it's about emotional discipline. Benjamin Graham puts it perfectly: investment success doesn't require genius-level IQ, but rather a sound intellectual framework and the ability to keep emotions from corroding that framework. Wall Street creates complexity to sell you products and services, but the art of investing is much simpler than they want you to believe. Remember, before Ben Graham, investment funds treated markets like casinos. He brought scientific methodology based on data and numbers to Wall Street. In this video, we'll break down 6 game-changing lessons from the legendary book The Intelligent Investor, the same book that made Warren Buffett a billionaire. Lesson number 1: the emotional business partner who tries to buy your company every single day. Graham introduces us to Mr. Market, your imaginary business partner. Every day, he knocks on your door offering to buy or sell your shares. But here's the thing: he's completely unstable, euphoric today, depressed tomorrow. The key insight? Mr. Market is irrational. You need to be the rational one. In 2000, he priced tech stocks at absolutely insane levels. By 2003, high-quality companies were practically being given away. Think Amazon at $6, Apple at $7. We don't need to look back decades to see this madness. Just a few years ago, Meta was trading at $90. Today? It's grown over 500%. This highlights the pure insanity of market pricing. Graham's advice is crystal clear: never follow the market's mood swings. Instead, think like a business owner. Know the real value of what you own. Ignore the daily noise completely. Take McDonald's as an example. Over the last 20 years, it faced multiple drops of 20% to 50%. Yet the business kept growing steadily. The path wasn't smooth, but the destination was profitable. Here's a golden rule: treat your stocks like your house. You don't call a realtor every day to check your home's value. Why torture yourself checking your portfolio every hour? But how do you turn this theory into a practical strategy? Here's the approach for people who hate surprises. Lesson number 2: how to invest when you hate surprises, the defensive strategy. Don't have time to analyze balance sheets every day? Welcome to the Defensive Investors Club, and there's no shame in that game. Graham recommends the classic approach: 50% stocks, 50% bonds. Rebalance every 6 months if it shifts more than 10%. Hold 10 to 30 diversified stocks from large, stable companies. Focus on businesses with at least 20 years of consistent dividend payments. For bonds, stick with solid government bonds, primarily U.S. Treasury. Here's what not to do: never chase last year's hot performer. The best performing fund this year often disappoints next year. It's called regression to the mean. And if picking individual stocks feels overwhelming, index funds and ETFs are your best friends. Low cost, zero drama, maximum efficiency. Warren Buffett himself recommends index funds for most people, and Graham would probably love what John Bogle created with Vanguard. Why? Because consistently beating the market is incredibly hard, and frankly, not worth the stress for most investors. Studies show that a simple S&P 500 ETF has outperformed roughly 90% of professional fund managers over 15+ years. But maybe you're thinking, I want to do more research and potentially earn higher returns. If so, you need to know the strict rules of the enterprising investor. Lesson number 3: when deep research pays off, but only with iron discipline. Want to put in more work for potentially higher returns? You can become an enterprising investor. But you absolutely need strict rules, no exceptions. Graham's criteria are tough: price below book value, PE ratio under 15, debt lower than working capital, earnings growth of at least 33% over 10 years. What to avoid at all costs: IPOs, trendy stocks, story companies with no profits. In the 1990s, everyone chased dot-com dreams. By 2001, most portfolios were destroyed. In 2008, when everyone panicked and sold everything, Buffett was buying Goldman Sachs, General Electric, Bank of America. Look for solid companies that might be boring but are definitely undervalued. Think Coca-Cola in the 1980s or American Express after the 1960s scandal. Hey, quick favor. If you're finding this valuable, smash that like button. It really helps me know you want more content like this. And if you're not subscribed yet, what are you waiting for? We break down the world's best investment wisdom every single week. Here's a mistake I made personally. In 2023, I sold Meta, Kroger, and Sprouts after 70 to 100% gains. I felt smart taking profits. But I could have made much more by simply doing nothing. Stop for a second. Be honest with yourself. Are you a defensive or enterprising investor? Your answer determines your entire strategy moving forward. Now that you've picked your path, let's learn about the concept that can save you from expensive mistakes. Lesson number 4, margin of safety, your investment insurance policy. In 1973, Warren Buffett bought the Washington Post for $83 million. Its actual intrinsic value? Around $400 million. That massive gap is called margin of safety. Graham created a simple formula to estimate value. Value equals earnings times 8.5 plus 2 times expected growth rate. The golden rule: never buy at the peak of your optimistic expectations. Even the world's greatest company becomes a terrible investment if you overpay. Perfect example, Apple in 2016. Everyone thought Apple's best days were behind them. They'll never innovate without Steve Jobs. Buffett started buying when others had given up. It became Berkshire's most profitable investment ever. Now, markets today are different from Graham's era. Modern companies, especially in technology, often have incredible profit margins and deserve higher valuations than traditional businesses. Some growth companies with explosive potential might justify PE ratios of 50, 100, or even higher, but you still need that margin of safety. But remember, margin of safety doesn't mean zero risk. Here's how to build the perfect balance. Lesson number 5, you don't need to risk everything to win big. Think higher risk automatically means higher returns? That's not always true. Imagine someone offering you $10,000 to shoot yourself in the hand. High risk, decent reward. Now they offer $100,000 to shoot both hands. Higher risk, higher reward. But does it make any sense? You can achieve high returns with relatively low risk if you buy quality assets when they're priced below fair value. Buy businesses, not lottery tickets. And always diversify intelligently. Combine stock ETFs with bond ETFs. When stocks crash, bonds often hold steady or rise. Your portfolio can actually breathe instead of suffocating. This lets you rebalance like a pro, sell what's gone up in price, buy what's temporarily down. Be greedy when others are fearful. Dollar cost averaging is your secret weapon against market timing. Invest the exact same amount every single month. Set it up automatically through your broker. When markets are expensive, you buy fewer shares. When markets crash, you buy way more shares. Your average cost smooths out over time. You don't need to predict anything. Just invest consistently and let mathematics work for you. But even with the perfect strategy, there's one enemy that can destroy everything. Lesson number 6, your worst enemy stares back in the mirror. The biggest risk to your wealth isn't market crashes. It's the person looking back at you in the mirror. Jason Zweig writes, the investor's chief problem, and even his worst enemy, is likely to be himself. When markets crash 20%, 30%, or 50%, the real problem isn't temporary paper losses, it's the overwhelming urge to panic and sell everything. Graham's solution? Write yourself a contract. Your name, commit to long-term investing. I will ignore media panic and market hype. I will stick to my plan for at least 10 to 20 years. Print it out. Sign it. Take a photo. When you feel the urge to sell during the next crash, look at it. Easier said than done, right? The most important thing is owning assets that let you sleep peacefully during any market storm. Historical fact, over the past century, investors have endured at least 3 market crashes exceeding 50%. Anyone staying in the market long-term must be mentally prepared for this reality. Benjamin Graham didn't just write a book, he left us a blueprint for financial freedom. A complete manual for avoiding Wall Street's traps, media manipulation, and our own psychological pitfalls. The intelligent investor sells to the optimistic crowd, and buys from the pessimistic crowd. Value is eternal. Price is temporary. And as Buffett perfectly summarizes, be fearful when others are greedy, and greedy when others are fearful. Have you read The Intelligent Investor yet? Drop a comment and let me know what you thought. And in our next video, we're diving into the scandal that shocked Wall Street, Enron. A fraud so sophisticated it even fooled Warren Buffett himself. Don't forget to subscribe and ring that notification bell. We're breaking down the world's greatest investment wisdom every single week.